Hey guys, I am back with another important lesson from one of our greatest investors, Howard Marks. In the book Richer, Wiser, Happier, Howard Marks said that buying cheap is the single most reliable route to investment riches and overpaying is the greatest risk. That makes sense, right? The more you pay, the greater your risk. But how do you know when you're overpaying? How do you know when you're buying something cheap? Just because something was selling at $100 at one point and it's now selling at $20, does that mean it's now cheap? For example, if you bought a car at $100,000 and later on you decided to sell it at $20,000, but it's wrecked and none of the parts are sellable, is it really worth $20,000 just because that's the price that you advertised? No way. I would say that the car is worth nothing. If I can't use it, then it has no value to me. And that's the difference between price and value. In the stock market, we have to remember that every stock has a company behind it. And often, the price of the stock is nowhere near the value of the company. This past 10 years, most stocks were priced higher than the value of the companies behind them. Our goal as an investor is to find great companies that have greater value than the price that it's selling for today. We want to buy at a discount. We want to buy cheap. That's great, right? But how do we determine the value? If you find this video helpful so far, please tickle that like button so YouTube can know to spread it to more people. Thank you. Okay, now going back to our question, how do we determine the value of a stock? The reason why we invest is so that we can make our money grow, right? So if I say to you to give me $12 today and I will give you $1 a month for the next 12 months, you're probably gonna say, go ahead, keep that $12. I don't care. So thank you for being so nice. But if I ask you for $12,000 today and I tell you that I'll give you $1,000 every month for the next 12 months, you probably won't agree to that. It wouldn't make sense for you to give me $12,000 today just so you can get your money back in a year. But if I ask you to give me $12,000 today and in return I'll give you $2,000 per month, which will be your cash flow for the next 12 months, then you'll probably say yes to that because you're doubling your money in the next year. So you're really paying me $12,000 today so that you can get some type of return in the future. That's the same thing that we do in the stock market. One way to value a company is to estimate how much money they're going to make or the cash flow they're going to bring in. And based on how much return we want to make, we can calculate a price that we want to pay for today. Calculations giving you heebie jeebies? Wait, relax, don't panic. We live in a computer age. So you really just need to learn where to look for the numbers and where to plug those numbers. And all these things are repetitive. So the more you do them, the better you get at it. Head over to my website, optionwits.com, and I'll be happy to walk you through the step by step process.